Alright, in this video I want to go over a theory, kind of a theoretical construct that helps explain the behavior of quite a number of stocks in the modern stock market. And the theory is that there's literally a shortage of shares of stock in certain types of companies. And okay, like a lot of theories that are sort of out there, on one level it seems sort of dumb, right? Because we kind of know that companies can issue shares whenever they want. They often do in the form of options granted to management or their employees. Sort of poorly run companies do tend to dilute shareholders, and companies that don't have very good cash flow characteristics often are forced to dilute shareholders because sometimes they need cash, they don't have it on the balance sheet, and they've got to issue equity to generate it. So this is a genre of companies that don't have those traits, right? These are companies that are very well run, have excellent cash flow characteristics, tend to be in oligopoly or like semi-monopoly type markets. And by that I mean some of the biggest industrials, some of the biggest tech companies. Apple and Cisco and Microsoft are very cash generative businesses, and they don't have a lot of competitors. Among the industrials, you've got very high quality companies like Honeywell, Caterpillar, Deere, that also are in oligopoly markets and have very good cash flow characteristics. These companies are buying back stock, and they've been doing so for a number of years. If you look at Deere and Cat's financial statements, say for the last 7 or 8 years, the share counts are down something like 30 to 40%. So like in the example that I did in video number 9 of the simple example of a small company with a buyback, you actually are seeing this playing out with certain high quality companies. So what that does is that means that the existing shareholders who don't sell have a growing portion, their ownership of the pie gets larger, and earnings per share, if you think about it, if you buy back half your stock, your earnings per share, all else equal, is doubles basically, right? If you earn $1 per share with 1 million shares outstanding, you buy back half of that share count over, say, several years. Even if your business doesn't change, that dollar per share, once the share count is reduced by half, now becomes $2 a share, right? So that implies a doubling of the stock price. Even though the business is the same and the market value of the company is the same, your shares actually will augment in share price because of the buyback. So there's a direct result as well. So think about this as a driver and think about the great companies that are out there. Now, I'm not saying that now is a good time to buy them. This is just an explanatory mechanism to explain why stocks are going up and why it may be justified. But the shortage of shares theory, this is a thing to start to roll around in your head and think about what kinds of companies, when you're investing, what kinds of companies do you want to invest in? Do you want to invest in companies that have very good cash flows? Yes. Do you want to invest in companies that are consistently buying back shares? Yes. And you want to try and avoid companies that are serial diluters. So use this as sort of a lens to measure the companies you invest in, and just think of it as sort of a way to explain the behavior of some of the highest quality companies in today's stock market. As always, I hope these videos are helpful, and thanks as always for watching.